Welcome back to our channel. So there's this article in the Motley Fool saying cash out refinancing activity has soared and should we be worried? So let's discuss this. So it goes on to say that US homeowners took out $152 billion in equity out of their homes, a 42% increase over 2019. And it says that it's the highest level since 2007, just before the financial crisis hit. They acknowledge the fact that what happened back then and what's happening now are similar by saying it was the wave of cash outs in the early to mid 2000s that played a big role in the near collapse of the housing market back then. But then he goes on to say that as a certified financial planner and longtime stock market investor, I can tell you firsthand that one of the most dangerous phrases you can hear is "this time's different." But it actually is. For one thing, the lending market has been fundamentally transformed compared with the pre-crisis years. He also goes on to say debt isn't just about the dollar amount, it's how much it costs the borrower. If the new higher debt loads carried by America's homeowners aren't translating to proportionally higher monthly payments, they aren't necessarily a cause for alarm. In essence, what he's saying here is that because interest rates have dropped so much, even if people were tapping into their equity and taking out larger loans, the monthly payments are either about the same or less than they were prior to the refinance. Therefore, it's not a cause for alarm. But what he's leaving out is the fact that equity matters. The percent of equity that you have in your home matters. So if you have 30% equity in your home, and housing prices drops by 20%, you're not fazed by that. You're able to still sell your home and pay off the mortgage if necessary, and if worse comes to worse. But if you tap your equity and you only have 10%, 20% equity in your home and house prices drop by 20%, well, now you have no equity and there's less of an incentive to pay that mortgage. Whereas if you had equity in the home, you're still incentivized to pay the mortgage or at least pay it off by selling the home, worst case. Now, if house prices drop below and then you have negative equity in the home, you basically owe more than the home is worth, you are a foreclosure risk. So tapping equity, no matter what the monthly payment is still a risk. Looking at Freddie Mac's statistics on refinances, we see in the fourth quarter, 38% of these refinances had a loan amount that was 5% higher than the original. 60% had no change. So about 4 in 10 of these refinances are taking out more loans. Let's take a look at this data from Black Knight. Of all the mortgages that are taken out, about half of them are refis and half of them are purchases. It says here, nationally, 52% of loans are purchases and 48% are refis. This chart should be a little concerning. It's a graph of the mortgage rates for different types of mortgages. So 30-year conforming, 30-year jumbo, 30-year FHA, and 30-year VA. And we bottomed out in December, January, and February, and now we're back on the move. With inflation expected to go up, yields are going up, mortgage rates are going to follow. And this is of particular concern because it's going to keep people from being able to take out mortgages for these inflated home prices. This graph does a good job showing that the 10-year treasury yield and mortgage rates are tracking each other, at least since December. They've both been on an uptrend. So here is a good representation of how the refinances are taking over the loan market. In blue, we have rate term refinancing. So they kept the mortgage at the same, but they just lowered the rate. And in orange, it's the cash out refi. And when you add them up, you can see that they are about the same or even greater than the purchase. So refinances make up 48% of total loans. This chart is showing us that the national refi rate is at 48%, but I wanted to circle back here to see Los Angeles, 63% of the loans in the Los Angeles, Long Beach, Anaheim area are refinances. 62% of the San Francisco, Oakland, Hayward, California areas. Then we can see 60% of the San Diego and Carlsbad areas are refis. 57% in the Riverside, San Bernardino, Ontario, California areas. And 57% in the Sacramento, Roseville, Arden, Arcade, California areas. So California is showing up on this list as having the highest rate of refinances versus purchase loans. This is going to be spelling a disaster for California because so many of the people are taking out equity from their homes. California real estate is looking rather scary here. They are leading the nation in refinances, leading the country in people fleeing the state, leading the country in the least affordable homes in the country. In essence, people are either leaving the state or over-leveraging themselves in homes that they are staying in. Demand is going to struggle because the affordability is just not there. As interest rates rise as they have been and home prices dip even just a little, what is going to happen to all these people in refinances where they owe more than the home is worth? It's going to happen. We just don't know when. Thank you for listening till the end. Bye.